Everyone thought Japan was on the path to higher interest rates. The markets were confident. Investors were all in. But the Bank of Japan just flipped the script, slashing growth forecasts, sending the yen tumbling, and signaling that rate hikes may be off the table for good. So what triggered this sudden shift? And what does it mean for global markets, currencies, and your portfolio? Stay tuned. This story is bigger than it looks. Let's break it all down. The Bank of Japan just made a major shift in its policy outlook, and it sent shockwaves through the currency markets. For months, many investors believed the Bank of Japan would continue raising interest rates, but that expectation has now been completely wiped out. This week, the BOJ kept its interest rate steady at around 0.5%. No surprise there. But what really shook the market was what came next. Japan's central bank sharply cut its forecast for how much the economy will grow. It now expects the economy to grow only 0.5% in 2025 and 0.7% in 2026, much lower than previous estimates. On top of that, it said inflation will likely fall below its 2% target, with a new forecast of just 1.7% for 2026. That's a clear message. The BOJ doesn't think the economy is strong enough for more rate hikes. In fact, if things get worse, the next move might not be a hike at all, but a return to ultra-loose policy. That could mean taking interest rates back to zero or even negative again, and possibly restarting money printing programs like buying government bonds to push more money into the system. Why the sudden change? The BOJ pointed to extremely high uncertainties in the global economy, especially around trade. New tariffs, particularly from the U.S., are adding pressure on Japan's exports, and that could hurt both inflation and overall growth. At a press conference, BOJ Governor Kazuo Ueda said Japan could enter a period of slow wage growth and weak inflation. He also admitted that the central bank's previous expectations may have been too optimistic, and that future revisions to its outlook are likely. This surprise pivot had an immediate impact on the currency markets. The yen dropped sharply, reversing weeks of gains. Just a week ago, the dollar-to-yen exchange rate dipped below 140. After the BOJ's announcement, it jumped back above 145 and may soon test 150 as traders rush to exit their yen positions. That's because many investors had bet the yen would rise as Japan hiked rates. But when the BOJ signaled that rate hikes are likely over, those bets quickly turned into losses, and traders rushed to sell the yen. The result? A stampede of outflows from the Japanese currency. Meanwhile, U.S. assets still look very attractive to Japanese investors. That's because U.S. interest rates are much higher, so investors can earn better returns by moving money into the U.S. This difference in returns, called the yield differential, encourages Japanese investors to sell yen and buy dollars, which weakens the yen further. Big reputable investment firms had previously believed that the yen would rise. They were very confident in that trade. But now even they are rethinking that view. They're backing away from their strong yen position and are instead recommending safer or better bets elsewhere, like betting the euro will rise against the dollar. The BOJ's latest decision also highlights a deeper issue. The effects of past government spending are fading. After COVID, Japan spent a huge amount of money to stimulate the economy. That helped push inflation up for a while, which the BOJ wanted. But now that boost is disappearing. Inflation is slowing, growth is weakening, and the central bank is stuck. If inflation continues to stagnate and growth stays weak, the BOJ might be forced to go back to policies it used for years, like zero or negative rates, or even printing more money. That would be a big step backward from what many had hoped would be a slow return to normal. In short, the Bank of Japan has hit the brakes on raising rates. It's worried about trade disruptions, slowing growth, and falling inflation. Investors are pulling out of the yen, the currency is dropping fast, and the central bank is now in a tight corner with limited options. What comes next could be a return to ultra-loose monetary policy, a sign that Japan's economic challenges are far from over. Thank you for tuning in. If you found this analysis helpful, make sure to like, subscribe, and click the bell icon to stay updated with our deep dives into global market trends. Let us know in the comments. Do you think the BOJ is making the right call, or is it delaying inevitable issues? Until next time, stay sharp and informed.